So today I'm going to do a bit of an education video for you guys. So it's just going to be me, you, the whiteboard, and today I'm going to talk about something that I'm seeing a lot in the stock market scene, especially in like the YouTube comments, on message boards, a little bit on the Discord, not as much on the Discord, but sometimes it's there. And this video today could actually help you make thousands of pounds. And I don't normally say that, but this video is probably going to help you make thousands of pounds and will help you or stop you from maybe making one of the biggest mistakes you're going to make in the stock market. And this mistake could potentially be something that stays with you for many years, where you go, oh, I wish I didn't make that mistake. I wish someone told me that during that time period. So hopefully this video is useful for you. Now, for you guys on the Patreon, you've kind of seen this video already, because back in 2023, what looked like the start of the bull market, I actually made a video which was a bit of an education video saying this is what you need to do now we're in a bull market. But obviously that was on Patreon and you guys on the YouTube didn't see it, and maybe that's why I'm seeing that mistake a lot more in the YouTube scene at the moment. So let's just take a bit of a step back. So in 2022, we had the worst stock market crash since 2008. It was a horrible stock market crash. We have not seen a crash like that for a long time. You know, 2020 we had a stock market crash and it was the CV situation, and yeah, it was brutal. There was 3 months where it just went down and down and down. 2018 was a bit of a bad stock market, but this is the first stock market we've seen since 2008 where it was a year and a half, you're going on your account every day and it was going down and down and down, and it was an awful time in the stock market and it hurt a lot of investors. A lot of investors have left the market and quit the market since that time frame. And if you look at my YouTube audience, for example, I've split it up into the 40, 40, 20. Now, if you look at this group here, 40% of my audience, I would say, is investors that have been through the whole stock market crash. So they were investors that were watching YouTube, my YouTube channel, were invested into the stock market before the stock market crash. These investors might have been in the market for 30 years, 20 years, 10 years, 2020, 2021, before the stock market crash of 2022. I'd say 40% of my viewers right now are them guys, which isn't a lot really when you look at it. And those guys saw their accounts go down, kept buying, and are starting to see the rewards now. I'd say the other 40% of my audience is people that started investing during 2022. So you guys that started during that time frame, you didn't see your accounts go down, so you've still got that to go through. That's definitely a shock when it does happen. But a lot of you guys started buying during the dip of 2022, and you've done really well. In fact, you've timed investing into the stock market absolutely perfectly. So some of you guys are, sitting on $3 of average of Hims and Hers shares, $10 average of DraftKings, which is up mega amounts. So some of you guys are sitting on absolutely crazy averages because you started relatively at the bottom of the market, which is absolutely insane. And then we've got 20% of my viewers, I would say, that are people that were in this category. The stock market crash happened, they got burnt, they panic sold, they were like, this is too much for me, and now they've missed the rally and they're now bears. They're bears that now look at the market rally and going, yeah, it's still going to go down, but this isn't still doing very well. They're people that are now bearish on the market because they've got burnt. We're in the market, the panic sold at the bottom market, and now they missed out, and that's where the bears come from. So that's the other 20%. So these guys here, they've messed up. They've messed up many years of shares of returns because they panic sold. Unfortunately, that's happened. That does happen in the stock market. And the video today goes from you guys here, especially you guys, but you as well, the ones that have been through the whole stock market dip, and especially you guys that are selling amazing averages. I think this is what you guys here have potentially very good gains, and you guys here, I don't want you to get so carried away with seeing the gains at the moment. So what I'm seeing at the moment is a massive selling mistake going on. And from these guys here, what's happened is they've seen their account maybe down for a year and a half, and they're starting to see gains now. They're starting to see DraftKings, I'm up 10%, I'm up 20%, I'm up 30%, I'm up 40% on DraftKings. Hims and Hers, you might have an average of $6, and today you're up over 100%, and you go, oh, that's really good, that. And because you've seen so much negativity for a year and a half, you're tempted to go, oh, I've actually got some green stocks in my account. I'm going to sell 50% of that stock off. I'm going to sell 60% of that. I'm going to sell all my position in that stock on an average of, say, $6 of HIMS. And some of these guys here that are on maybe like a $3 average of HIMS, they're going, oh, look, I'm up 400%. I'm going to sell that. Like, look how much money I'm up. I'm going to sell that. And look, at the end of the day, we're all here to make money in the stock market. That's why we do it. We all want to make money in the stock market. But what you've just done is, say someone has HIMS at $6. Oh, that's terrible, $6. Or you have HIMS at $3, right? Some of your averages that you have on these stocks right now are averages on great companies. Great companies that are financially going to perform for the next year, 2 year, 3 year, 4 year, 5 years. Could majorly perform. And what you have at the moment is you have averages that you bought during the worst stock market crash since 2008. Now, the only way you're more than likely, there might be one stock that breaks this trend that you have bought. There's always the possibility that a stock can fall off the edge or some issue comes out. But a lot of these stocks here, you're never going to get that average again on some of these stocks. I'm just going to say it right now. You might not get that average again. You only got those averages. The DraftKings was thrown under the bus down to $10. HIMS was thrown down under a bus under $3. You only got those averages because we were in a stock market crash. The worst stock market crash since 2008. The only time you're ever going to see them stocks again at them prices is if we get another stock market crash. Now that could happen tomorrow, but the chances of it happening are very slim. And if you look at history, bear markets, stock market crashes come along every 4 years, I think it is. So only every 4 years you have them opportunities to buy them unbelievable stock. And it's tough. The 20%, it's tough to buy in that stock market crash. But those opportunities are very rare. Only come around every 4 years. And the chance of you buying those stocks that you've bought in this dip in 2022, the chance of getting those stocks at them price again are very slim. The next time you're going to see them sort of dips on stocks is when we get a next stock market crash, which might be not for another 4 years. And by the time another 4 years comes around, what are these stocks going to be? They're not going to be $6. If in the next 4 years, if HIMS and Hers do the numbers they've done right now, the stock is going to be up to, let's say, $25 in that time frame. And if that stock was to fall 50% on HIMS and Hers, it's still going nowhere near $3, right? So a lot of people have amazing averages on amazing companies, and if they financially perform, they're going to do absolutely amazing. And you do not want to set. We could not have a stock market crash for the next 4 years. And you could see some massive rewards now. You get them rewards from buying them dip and they financially perform and you're going to have major share price performance. The last thing you want to be doing right now is go, oh, well, I've got HIMS at $6 and it's up at $12, so I'm going to sell all my position out now for a 60% gain, 70%. If this stock is now going to perform amazing for the next few years and you have a good average, this could be a really good performer for you guys. And at the end of the day, if you're going to sell it, what are you going to go buy? The chances are there's nothing that you could potentially buy that's as good as having an average of HIMS at $3. You don't want to be selling a golden opportunity. You bought that golden, you don't want to sell it too early. And I'm seeing a few people that have these amazing averages on amazing companies. You need to sit on the hands now, guys. You know, be them dead investors, because if you've got amazing averages on amazing businesses, you're going to do very well, and you want to hold them. If they financially perform, they're going to bring you really good share price return. And the chances of you finding another opportunity on the market as good as that is very slim. So be careful. If some of you guys are sitting on really good stocks and businesses at amazing averages, don't jump out into it. I'm seeing people that are going, oh, I'm selling out of HIMS now. And they're selling the full position out of HIMS and DraftKings. I'm like, hold on, if these stocks are going to financially perform for the next 4 or 5 years and you've got why are you doing that? Unless you can find an opportunity that will generate the returns you're going to get from them stocks, you know, why are you doing it? Now, at the same time, you know, if you have these, you know, really good averages and you're up crazy amounts of stocks, there's nothing wrong with taking a bit of profit off the table. You know, if you think, oh, yeah, that stock's run up a bit, oh, you look at the valuation now, yeah, the valuation's a fair valuation, it's a bit of a fair, I might sell 10% of the position, I might sell 20%. There's nothing wrong with that. There's nothing wrong with taking a bit of profit off the table, but what I'm seeing at the moment is not people just going, I'm going to take a little bit of profit off the table, protect myself a little bit, it's run up a little bit, the valuation's a little bit stretched. I'm seeing people that are sitting on amazing companies, on amazing averages, and they're only just getting started, guys. You know, this is a bull market that we've had for 12 months, basically. If we're going to have a bull market for the next 3 years, guys, some of you need to be like dead investors, because some of the returns that you can miss out on could be insane. You know, look at Tesla. People sat on Tesla for years and it was a struggle. And then it got to 2019 and the stock went absolutely ballistic. And a few people saw the first kind of 100% return and they sold out and go, oh, it's gone up a lot. I've been in this stock for a while. It's not done anything. 100%, I'm going to take it out. What they didn't realize is then Tesla went on to be a 10 bagger. And if you sold too early just because it gone up a little bit and you've been sat there for a while and you saw a bit, I'm going to take off the 10, you missed out on a 10 bagger and it really cost you. And that company was during that time frame of 2019 up to 2022, that company was absolutely firing on all cylinders. And if you're selling out a company when it's just starting to kick on too early, you could be selling a gem that will make you a lot of money. You get a 5 bagger or a 10 bagger, that is the difference of absolutely smashing the market. If you're going to smash the market, you really need to be hitting a 5 bagger or 10 bagger in your portfolio. One of them in your portfolio can make a big difference. If you ever go read the book, I hope this is on screen, One Up on Wall Street, which is somewhere around here, read that, and the difference between a portfolio without a 10 bagger or a 5 bagger and the difference in returns of having a 5 bagger and 10 bagger, it's massive. And you could be sitting on one of them very easy because you've got an amazing average on a really good company. And if you sell that out too early, you might regret that. You might look back in 5 years' time and go, look at how much that stock performed, absolutely amazing. Example here is when I first got in the stock market, I bought a company called Ferrari. I'm sure you've all heard of Ferrari. IPO'd, stock went down on IPO, bought it. One of the first stocks I owned, I made up 100% on the stock. I didn't really know what I was doing at the time. And I was looking at Ferrari going, I'm up over like 100% here. And there's not much, back then, even though it wasn't too long ago, there was nothing on the internet to help you guys. And I went, you know what, I'm going to take my 100% return off the table here with Ferrari. I've made my first bit of money. Yeah, I'm happy with it. Look back now, 2024, 6-7 years later, I'm looking at Ferrari going, I wish I did hold that position. If I hold that position now, it would have been a 5 bagger. And I would have one of the strongest brand names out there, Ferrari, at an average of, I can't even remember what it was now, it was like $40 or something, or $50. It was an insane average. And if I held that stock now, it would have been insane returns. And I don't blame myself too much because I was new to the market and I didn't have anyone to help me out there. But realistically, Ferrari, where's it going in the next 5 years? That brand name, absolutely amazing business. I should have held on to that stock a lot longer than what I did. And that's an example of me where I went high quality business, had an amazing average after an IPO dip, and I should have held it, and that would have been absolutely a smashing return. Now there's other instances where you do sell at the right time, where a company, maybe the financials start deteriorating and then you do sell out, maybe the valuation goes absolutely ballistic and you're like, but then again, you know, if it's an amazing company, then eventually the valuation, the financials will catch up to the valuation at the end of the day. And maybe you protect yourself. But there's a few people that I'm seeing that have gone through this bear market with amazing averages on amazing businesses, and now that they're seeing a bit of green, they go, right, I'm selling out. And they've only held it for like 6 months, a year. You know, if you look at companies like DraftKings and Hims, imagine if those businesses do those financials for another 5 years, another 10 years. If they do those financials for another 5-10 years, is the stock going to be valued where it is right now? Or is that stock going to be valued a lot higher? That's what you've got to ask yourself. And once you've got your answer there, then you should know what to do. Hope you enjoyed the video, guys. Do not make a mistake of selling a very good business at a valuation just because you are up on it. Start thinking about the long term. You might need to be a bit of a dead investor, sit on your hands on amazing companies, on amazing averages. Hope you enjoyed the video, guys. See you in a bit.